Hi, my name is Pat Papano. I selected this image for my book because it seems to convey a person who's both overwhelmed and intrigued by the stock market. The fact of the matter is that unless you inherit or win the lottery, the stock market is for you. But many people don't know this. They think that the stock market is for rich people. That's why I selected this image. The person in the picture seems to understand that he needs the stock market, just doesn't know how to go about using it. Rich people have the bond market where they can pursue a strategy of preserving their wealth, which is what they want to do. But ordinary people, they don't have wealth to preserve. They're interested in growing wealth, and that's why the stock market is for them. My book, Owning Main Street, is a beginner's guide to the stock market, a guide that takes you on an inside tour of Wall Street, exposing you to the various investment instruments available, but in the end channels you towards simply investing in the common stocks of a few of the great global corporations. The purpose of showing you Paris, but then encouraging you to go back to the farm, is that Paris is really not likely to get you where you need to go, and the farm is. Besides, if you really want Paris, you'll find it in this book. But believe me, just plain old common stocks like steak and potatoes gets the job done better than any fancy souffle. So reading this book is like going on a cross-country trip. You'll pass many side roads, but realize they're only distractions that don't go anywhere. And at the same time, you'll be guided on a route that'll take you where you need to go, to an estate that will allow you to retire and maybe help the kids along the way. Wages grow at an annual rate of about 4%, just slightly ahead of inflation. And that's when whatever job you're in, because of inflation, your employer is more or less obligated to raise your wages. And it's not really a raise. All they're doing is making an adjustment to keep pace with inflation. So you're really being paid the same amount, or maybe just slightly ahead of inflation. So your wage growth is going to be just slightly ahead of inflation. And so that's not going to be a way for you to create wealth, because whatever you put aside will then get eaten up by inflation. The stock market, on the other hand, returns something like 9% per year, or about 5.5% ahead of inflation. And so that's 5.5%. That's the way you're going to grow your wealth. Now, if you take a family that has a household income of $100,000 a year and they're going to work 30 years, that means that over that 30-year period, they'll earn $3 million. At a savings rate typically of 5%, that means that when they're ready to retire, they'll have $150,000 to retire on. You can't retire on $150,000. Even if they double that to a 10% savings rate, that would only be $300,000, and you can't retire on that either. But you can retire if you take about 5% of your savings and put it into the market and grow it at 9%. Then that will give you, over a 30-year period, a retirement that you can live on. But it won't be easy because, as this chart shows, inflation isn't between 3 and 4% every year. That's only the average after many years. The inflation rate is actually quite volatile on a year-to-year basis. But this is not a reason not to invest. It is a call to action. It's a reason to invest as soon and as often as possible so that you can stay ahead of inflation and grow your wealth. But then again, the stock market is very volatile too. In this chart, you can see that over this 43-year period, the average annual market return was not 9%, it was almost 11.5%. So that's the kind of a growth engine that you need to grow wealth. Okay. In addition to managing the accumulation period, there are also suggested practices for disinvestment, which would start perhaps 30 years from now. As you can see, the difference between withdrawing at a 7% rate and a 10% rate is quite dramatic. In the one case, withdrawing 7%, instead of 10%, you would think would give you less of an income. But in fact, the lower 7% withdrawal rate produces about 20% more income, plus it leaves 150% more capital. So what's going on? How does that happen? It happens because more money is left to work in the market. Okay, but there are also market factors to consider that are going to be out of your control. And this table illustrates the impact on the order of returns. The market is volatile. There'll be years that'll be down years, and other years will be up years. If you begin your investment during the down years, it'll be almost impossible to recover those early losses. If, on the other hand, you start your investment program during the up years, then you'll have immediately gains which will work in the market over the rest of the term. So the order in which returns come has a dramatic impact on how well you do. So that's another call to action. You can't just look at that and say, oh, well, I'm not going to invest. It's going to be a down year. You must invest a little at a time, all the time. That's the way this is defeated. Okay. Markets are not created, but they're found by alert entrepreneurs. Only buyers can create markets. Entrepreneurs can find them, however. And of course, what entrepreneurs are looking for are faster growing markets that can be defended. The product would have to be complex enough so that it's not going to immediately attract competitors. And it's a growing market which is going to be around for a while. That's what entrepreneurs are looking for. And when they find it, they will enter the market with what's called a question mark. Okay, this is a startup company. We don't know how successful it's going to be. It's just starting up. But that's what entrepreneurs, they take chances and risks based on their vision of what they see in a market. Then if they succeed in that market, they will appropriately enough become stars. And that's where they beat off the competition and then survive in a market that they have found. But they're still not going to be very profitable because they'll have competitors trying to gain market share. At some point, they'll beat out the competitors, and then that cash that was used to defend their position now goes out to stockholders as dividends, and then the company becomes known as a cash cow because it's spinning off cash to investors. That will go on for some time, and then what will happen is new competitive alternative products will come into the market. And so the cash cow will then start to decline as buyers migrate over to the newer solution. And at that point, the company becomes known as a dog and begins a decline, which may be fast decline or it may be a very, very long and slow decline. But in both cases, whether it's a cash cow or a dog, the position is no longer being defended. Profits are being spun off to investors, and there's a cash flow associated with that, and the companies are profitable. Now, most companies start out as a question mark, go through the star phase, through the cash cow phase, and the dog phase. That's really the life cycle of most businesses, and companies then have a number of businesses, some which are being developed and some which are being shut down or sold off. Okay, so in the early phase of a business, all of the money is going into product development and marketing effort. So there's no profit at that point. You're just creating a future cash flow for yourself. At some point, as competitors are driven off, then what happens is you can reduce the amount that goes to marketing and product development. You'll start to see daylight, and after a while that will climb up as the competitors exit the market, and the company may become very profitable. And that will go on for some time during a period of maturity, and then, of course, the inevitable decline, which could be very short or it could take a very long time. Okay, this is one company's, the way companies are typically made up of multiple businesses. Some businesses are just getting started, some are stars, some are in the cash cow phase, and some are in the dog phase. And what you see in this chart is that companies have various businesses which they manage. And they manage them for growth, to maintain them for cash flow, and those businesses that they feel are getting into a zone where they're going to be unprofitable, those are sold off or closed down. So what we've learned is that there are really two types of businesses. Businesses that are profitable, that throw off cash, and businesses that are being grown or harvested that may not be throwing off a lot of cash. But in the cash cow and the dog category, those businesses will experience both growth in their stock price, which is as the business grows, stock price will increase, and they're also spinning off cash as dividends. In this chart, you'll see a gray lower line, and that's the stock appreciation or price line or price return line. The blue line includes all of the capital gains from price appreciation plus the dividends. So the higher line is the stock price appreciation plus the dividends. So the upper line is often called the total return line. Okay, now in looking at a company that was not a cash cow that started out, was Starbucks, a very, very successful startup company. And in this chart of its stock price, you can see that it had quite a nice growth experience for quite some time. And then all of a sudden it fell. And then it recovered and then took off on another long run. Well, what happened here is that Howard Schultz, who started Starbucks, left the company, and the management that came in began not a growth strategy, but a harvest strategy. And without the passion for growing the business began to suffer. But what's interesting is that the revenue in the business only fell about 10% during this period, whereas the stock price fell almost 70%. And that brings up the difference between the underlying price behavior of the commodity, of the business, and the stock price, which is something quite separate. The actual corporate results declining only 10% is because, first of all, the original premise of the business that people wanted a premium coffee has not much diminished. That's not going to change much from time to time. Once a market is discovered, it's there, it exists, and it'll continue to be there to be served. What happened was that the market was not being served as well, so the business declined about 10%. Stock price, on the other hand, has no structure to it. Stocks can sell, for pennies or for dollars or for hundreds of dollars. And what will happen is when the decline is first seen by some of the stockholders, they'll want to immediately sell to preserve the earnings, perhaps, that they've realized up to that point. And they really don't care what they sell at. And plus, there are also panic-stricken sellers who'll sell at almost zero just to get out, just to be able to save some of their money. So while the business, the coffee business, is maintained by a pricing structure, which is the cost of coffee, the cost of renting the space, the cost of paying employees, and people have to pay that to get a cup of coffee. So the coffee is always sold at a profit. So that gives the price of coffee and the revenue to the business structure. In stocks, there is no underlying structure, and so stocks can move freely between zero and hundreds of dollars, and that's what they do. It moves freely. So here you're going to see a drop in revenue of about 10%, a drop in stock price of about 70%. Okay, now from the investor's point of view, however, the challenge becomes, at what point does an investor get out? Or would an investor ride this whole wild roller coaster ride and stay invested the entire time? It's difficult to imagine an investor who started out not selling out at some point during the decline. You'd have to have a iron stomach in order to ride that roller coaster. Okay, and then at the depth, as I said, Howard returns, and then the stock began to recover. So the only way that recovery could happen is that there were buyers for the new buyers for the stock. And so they then began to gain encouragement as they saw their stock price going up, and that would bring in more buyers. So gradually the stock price recovered. Now, the reason that stock price declines like that is that there will be news that a stock is in trouble. And people don't match up the news with a particular stock price. They just say, oh, Starbucks is in trouble, I'm getting out. So then what will happen is that once the Starbucks stock has fallen to some very low point, some buyers say, wow, Starbucks is still in business. How could that be if their stock price is so low? And they then see that the stock price has a life of its own, having very little to do with the fundamentals of the business, and then they buy in again. So at any rate, while the revenue from a company and the way the business is managed, the financials, those don't move all that dramatically from year to year, but the stock price moves very dramatically. And that's why, is because people hear the news and it's all acted not only on emotion, but emotion on rumor. That's what moves stock price. Okay, in this chart, you can see basic demand and supply line. And the more that the higher the price that something can be sold at, the more of that product will be supplied, because you'll have suppliers who will want to come in if they can make enough money to make their product. So as price goes up, so does supply. But then, on the other hand, as price goes down, then demand goes up, because people who are buying the product want as low a price as they can get. So, in this chart, what you see is price going from $0 to $100. At zero price, demand is very high, as you can see. Then as the price moves higher up towards 100, demand goes to 0. And the opposite happens with supply. When the price is 0, supply is 0. And then as the price goes up to 100, supply then rises to supply that greater profit. At some point, those two lines, the demand and supply lines, will meet. And it's at that point where markets clear with all at that price. Everybody who wants that particular product will be supplied that particular product, and the market's clear. Now, how do you handle a situation, such volatility as in the Starbucks case? I mean, you see this, your shares increasing in value, then all of a sudden they plummet down to even below what they were when you first bought them. Do you sell or do you hang on? The way you manage that volatility problem is what's called dollar cost averaging. And what you're doing in dollar cost averaging is that you are buying a fixed dollar amount every month. Sometimes the stock is up, sometimes it's down. Doesn't make any difference. You're buying a fixed dollar amount. When the stock is up, you buy very few shares. When the stock is down, you buy many shares, as you can see in this illustration with ExxonMobil stock. The price is up, very few shares are acquired. The price is down, many shares are acquired. Over a period of time, what you'll have with dollar cost averaging is you'll have an average share price, which will be significantly less than if you purchased a fixed share number every month. So in this chart, you can see compared where a person will buy 1 share a month, and that'll be 12 shares per year. So in the first year, they would have bought 12 shares at $10 each, $120. Whereas the other person would have bought $30 a month, and they would have gotten very number of shares. Then when the price went up, the person buying by the shares then acquires a number of expensive shares. Then when the late period, when the price is back down to $30 a share, again, the fixed dollar amount acquires more shares. The end result is that for the dollar cost averaging investor, the average price per share is $20.57, whereas the fixed share per month buyer, the average share cost is $40, almost twice as much. So the dollar cost averaging smooths out volatility. Now you're looking at something of 110 years of the Dow Industrial Average. And as you can see, it's a generally uptrending line, but there are dips in it, sometimes significant dips. And so this is what drives people into panic mode, is they'll buy and then they'll see their stock price start to decline. They think it's going to go to zero, and they immediately sell out. So look very carefully at this line, this chart, and wonder how you could possibly lose money when the line is always going up. And the answer to that is it's very easy to lose money. All you do is sell out your position and you will lose. So to prevent losses, all you do is just don't sell. You can acquire shares, but don't sell them. And to show you how that works, in this particular illustration, you'll see a number of purchases, 5 purchases made at the worst possible time at market highs. You really want to purchase shares at market lows. But in this particular illustration, all of the share purchases have been at the worst possible time at market highs. Yet what you see there is a generally successful investment trend in all of those lines. Every single line, just by holding on to the stock, you have seen a very nice investment trend. And believe me, in all those lines, even with the purchases at the worst possible time, you are far ahead of the inflation of 3.5% to 4% per year. Those are very good return lines. Okay, now, not of course every company makes it. So part of the investment process are selecting companies which are likely to remain in business over that period of time, and a number don't. So what you want to do is you want to go to the popular indices like the S&P 500 or the Dow, and you want to look at the constituents within those groups. Here you're looking at the constituents in the Dow 30. You can see when they were added to the index: GE in 1907, 3M in 1976, Procter & Gamble in 1932. All right, so these companies are then likely to be around for some time and would make good investment candidates, reliable investment candidates. Okay. Another way, and perhaps an even better way to pick stocks, is to look at companies who have prominent brands. A company can sometimes get all distracted by its product and forget that it's really the brand that sells the product. In other words, if somebody came out with a competing car to, let's say, the cars that you're familiar with, or competing beverages and so on, they would have a tough time selling in a market which has become accustomed to brand names as a way to assure themselves quality. And so some companies are very careful, and they know that they're not in the cola business, or not in the car business, or not in the electrical appliance business, but they're in the brand business. That's what a good sign of a good company is, that it understands that it is in the brand business, and it shows by the longevity and the recognition of their brands. And as you look at this chart, you can pick some out. Google, everybody knows the Google brand and the Coca-Cola brand. And all of these brands, so these are companies that have carefully nurtured and defended their brands. And so that means a sign of good management and a good place to look for investment candidates. Okay, here is another way to pick stocks is to look at yield or dividend. As we pointed out earlier, some companies in the cash cow and dog stage are able to spin off cash as dividends. And these dividends typically have a rate 1, 2, 3, 4, 5%, even higher. And this information is posted, easily available, so you can just pick out some companies that regularly pay good dividends. And so in addition to the price return you'll get on the stock, you'll also get a dividend or a total return from that stock, which is higher. Okay, then there are some companies that focus very heavily on their dividends, and they know that the people who buy their stock are very interested in dividends, so they make dividend distribution a big part of their business. And this is a list of those companies. Some of them are regular companies that you may be familiar with, power utilities, but some are partnership companies, which would be pipelines, real estate investment trusts, tankers, and then tobacco is a regular corporation, but although we don't want to support tobacco necessarily, they do make good investment candidates because you can't kick the tobacco habit very easily. Okay, now how many companies do you need to make up a portfolio? Well, for a long-term portfolio, an investment horizon of, let's say, 20 or 30 years or even 10 years, you could start out with just 4 stocks. 4 is all you need. And one of the reasons you want to keep it to 4 is that there are transaction costs to acquiring stock. There's a cost. Sometimes trades will cost anywhere from $5 to $100 per trade. So if you're going to be trading every month, that's a significant cost. So several ways you can keep your trading costs or transaction costs down. One is to limit your portfolio, limit how many companies you're invested in. Also, all you need are really 4 companies. That will give you the diversification that you need to give your portfolio some safety. In this particular case, you have 4 very strong companies, but they're also 4 very different companies. ExxonMobil is a company almost exclusively devoted to the energy market, to fuels of some sort, and oils and lubricants. If people stopped using machinery and they found other ways to heat houses like nuclear energy, ExxonMobil wouldn't do very well. So they're highly dependent on that product, but nevertheless, they're one of the leading players in that product. So it's very doubtful that ExxonMobil will suffer a big decline in business or go out of business. But nevertheless, it's a limited product company, so it makes up only a portion of a portfolio. McDonald's, again, is somewhat limited. It's strictly a restaurant chain for fast food, but they are all over the world, 119 countries last time I looked. And so they're very diversified geographically, as is ExxonMobil, but McDonald's is even more diversified. And then you have Procter & Gamble, which is very different than Exxon and McDonald's in that they have a gazillion products. And they have new products they're developing all the time and other products that they're divesting all the time. So it has a lot of stability just in the number of products that they have, but also Procter & Gamble is diversified globally, very strong, well-diversified company. So if I were only going to invest in one company, it would be Procter & Gamble. It's also historically been known for its very good management. Now, the three companies that we've discussed, they are all in the cash cow stage of their life cycles, and are growing, but they're not growing that rapidly. So in order to have a little bit of a growth component to the portfolio, we have Amazon. The other three do distribute dividends. ExxonMobil 2.40%, McDonald's 3.30%, Procter & Gamble 3.30% dividend distribution, but Amazon 0. And because all of the money that they make, they're plowing right back into the business to grow the business. And Amazon is a growing business. It's fast growing. And because the ambition of Jeff Bezos at Amazon is to sell everything. And he's not there yet. So he's continuing to grow that business. And for investors, they will have in Amazon quite a good price return, but the price return will be the total return. And I would say of these four stocks that Amazon will probably be the highest earner of the four stocks, but it will all be in price appreciation. The other three stocks, it'll be a total return, not price return only. So how do you acquire these? You can use what's called a DRIP approach, and DRIP is a direct investment. And that's because some companies sell their stock directly. They don't go through a stockbroker. And so you can buy stock directly from these companies. ExxonMobil and McDonald's both have direct investment plans. Procter & Gamble, I believe, does. They certainly did up until recently. Amazon does not. So the way a direct investment plan works is that you set up with the company through one of their agencies, transfer agents, like Computershare is one. You set up an account, and then they will withdraw monthly from your account, from your checking account, whatever amount. It can be as little as $25 a month, and then they will use that money to buy shares. And most companies who run DRIP programs do not charge any transaction fees. In other words, you're buying stock for free. There are no transaction costs. It's automated. By being automated, it takes the volatility out of the market. In the case of Amazon, who does not have a DRIP program, there's a company named Capital One Share Builder, and they offer a DRIP-like program where they will automatically debit your checking account. I think it's as little as $25, might even be less. And each trade, I believe, is $3.95. And so you can then elect a share builder, open up an account, elect stocks, and then you can have an automatic investment account. And that's, again, takes the volatility out, and using dollar cost average drives down the average cost per share. So what we have gone through is to show you that that a way out of the weeds. In other words, the Wall Street culture is made up of a gazillion ways to invest, in partnerships and bonds, and in stocks, in various mutual funds, closed-end funds, open funds, and there are literally hundreds of ways that you can invest through Wall Street, and each one, of course, purporting to be the be-all and the end-all way that's going to make you rich. At any rate, the only certainty of dealing with Wall Street is that they're going to make a fee on your money. Whether you make money or not, that's another question. So by focusing on dollar cost averaging through the prominent members of the Dow 30 or the S&P 500, what I have done is I have shown you a way through the thicket, that there is a line that gets you, it's a workaround from all the siren song of the different exotic investments which you don't need, generally don't do all that well, but just sound good. You just stick to the stocks of the great global corporations. You buy a little at a time, dollar cost averaging, and that's your route through the thicket that you see there. And I have written a book on this. This will, as I say, will cover all of the investment vehicles that are possible to buy, or at least most of them, but then we'll show you why those are not particularly good choices for you. Thank you very much.